The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. He's my good buddy, Wall Street for Main Street. His name is Jason Burack. Jason, welcome back to the show, my friend.
Thanks, George. I'm glad to be back on every 3 or 4 months and give your listeners an update on markets. I mean, we're living in absolutely crazy times. We don't really have conventional markets anymore. It's mostly just open or covert manipulations now.
Yeah, so I'm not sure when people will watch this, but just to give them some context of the time, this Build Back Better bill or act or whatever the heck it's called, this is pretty much getting shot down. And so, you know, I've been of the belief when I've tried to think through inflation and disinflation, I'm always trying to say, okay, well, how are dollars being created and how many are being created? And as you know, there were trillions and trillions of currency units created by the government deficit spending being monetized by the Fed that ended up on the balance sheet of the non-bank entities in the real economy. And I knew that once the government stopped, or if they were, you know, who know, back in 2020, it looked like the spending was just going to go on for infinity, which it probably will. But it goes through times where they put a pause on the amount of spending they're doing, and therefore fewer dollars getting into the economy. What do you think happens is if we go into 2022 and the government can't deficit spend like they were spending in 2020 and 21, what happens to the rate of inflation? I'm not saying there would be deflation, but do you think the rate of inflation goes down?
So the real economy, in my opinion, so the consumers, business owners, they're being, especially here in the United States, because we're not used to it, at least not at the levels that we've gotten the last 20 plus months, we've gotten killed with stagflation and taxes. So there's all these examples of cost increases are up double digits, labor costs, people are asking for higher wages, energy costs are up. I could just name the cost, business insurance costs, all these costs are up. It's nuts. And people are not dealing with that very, very well. Of course, they're not dealing with it very, very well. You're starting to see backlash, like you said, with some senators, some congressmen, it's not all of them, some of them in the lower income where there's more unemployment, there's not as much of a diverse economy, there's not as many different types of job opportunities, where those communities are saying that inflation is serious, my paycheck is going a lot less further, purchasing power. So yes, that could lower it. But the Fed, George, is trapped. So they can take a break. They're not really going to actually cut the amount of quantitative easing seriously. They're not going to raise rate hikes. I mean, they're not going to do anything serious. So I've seen people saying that the Fed can raise rates to 1.5%. The economy is just so much more leveraged at this point. Corporate debt has doubled since 2009. So Wall Street continues to want to sell more junk bonds, leveraged loans, collateralized loan obligations. You have hedge funds, family offices. It's not just Archegos. You have portfolio managers at investment banks leverage. You have record amounts of retail traders using leverage on cryptocurrencies, stock options. I think the amount of stock options trading has surpassed by retail investors, regular trading. So the economy is just way too leveraged, but inflation and taxes at the bottom up level are a problem. And then you have top down macro problems like what Jeffrey Snider's talked about with Eurodollar futures. And then with the dollar index rising, that is a big, big problem for the global economy because of too much dollar denominated debt. We've talked about this in the past on past interviews where the dollar is in a trading range for the last 7 or so years on the dollar index. And this is why the dollar is not really going to collapse, at least not anytime soon, because of the way the global financial system is structured with the amount of dollar denominated debt and the dollar standard that we're on, because the amount of dollar denominated debt borrowing, it goes in cycles. So every time the dollar index gets weak, and this happened in early 2020 after the dollar index got monkey hammered back down from 104, it then crashed. And the dollar index was weak. And you had all these people saying the dollar is finally going to collapse. The dollar index is going to break that 89 support level. It didn't rally. Right. because you had all these foreign governments and all these foreign banks and foreign corporations. Guess what they did? They were looking at relative interest rates. They were looking at relative interest rates of borrowing in dollars versus their own currencies. They were looking at their own governments and central banks also doing similar monetary policies to the Fed of monetizing debt. And they said, we're going to borrow dollars because the dollar's weak. This happens like this cycle is very, very predictable, unfortunately. So it was predictable that the amount of dollar denominated debt would actually start increasing. And in 2020, it increased, 2020, it increased by over 400 billion. It increased a lot, and it kept increasing in 2021 too. So we're over $10 trillion in total dollar denominated debt globally. No one knows the exact real number, but it's bad. So if the dollar index, which is, let me just pull it up here, the dollar index right now, when we're recording this interview on Monday at 4:06 p.m. Eastern time, is at 96.53. Yeah. The dollar index keeps rising to 97, 98, 99. You're going to have margin calls. So that's why you're starting to see there's a lot of factors involved with problems in China, George, with the Chinese real estate market. But it's been well known for years that the Chinese real estate developers are big, big borrowers of dollar denominated debt. They're some of the worst ones. So every time the dollar rallies, it creates even more problems. And now you have, maybe we could talk about this later in the interview, because it seems like you wanted to talk about the Fed and US federal government reducing spending. But the US federal government, and you've talked about this for the last couple of years, the Treasury general account is wiped out. So that was predictable. You knew at some point, one of the administrations was just going to max out the Treasury general account. They were going to wipe it clean. It went from over 1.1 trillion in the last couple of months of the Trump administration. It went down to, I think it was below 100 billion the last time I looked. So it's been totally wiped clean. The Treasury is basically hand to mouth. And at this point, George, this is what worries me. And I think this is, I did an interview on the radio. I did a radio interview recently with Mark Moss for iHeartRadio, and I laid out the case for this, how the finances for the U.S. Treasury over the last couple of decades have structurally changed over the last 2 or 3 decades, to where they are way more reliant on capital gains tax revenues on stocks, bonds, and real estate. If asset prices do collapse, so quote unquote deflation. So if there is a margin call for either the VIX rallying again, because the VIX was it was at 30 a couple of weeks ago. It almost crashed. Yeah. Okay. I mean, the VIX almost created that. Remember, you interviewed Christopher Cole in May of 2021. That was a superb interview. If your listeners haven't listened to that, go and listen to it. Either go and listen to it for the first time or re-listen to it now and watch the VIX. So watch the dollar index, watch the VIX. Those are going to, because of the amount of debt and leverage in the system, especially these leverage trades that these hedge funds, these family offices, these portfolio managers at investment banks like to put on, the dollar index rallying more and the VIX rallying more will create margin calls. So the VIX was manipulated, in my opinion, by one of the 4, 5, or 6 different plunge protection teams. It was at 30.
To suppress it?
Oh, yeah. Oh, yeah, it was smashed. It was a blatant smashing because the VIX, things were getting pretty ugly. I mean, the stock market now, George, if you watch the stock market now, the stock market's wobbling. It's teetering. It could potentially crash in the next couple of weeks or month. It's getting that wobbly.
I didn't even see what it was today. Yeah, I was going to pull that. Well, keep going and I'll pull that up.
Well, the VIX is not near 30 yet again, but it was dangerously close a couple weeks ago. After it hit 30, it looked like it was going to jump to 35, 36, 37. And that's almost at like Bear Stearns and Lehman Brothers levels.
Yeah. So I'm looking at it. I guess, let's see the market. I'm not sure if it's closed because I'm not on East Coast time. I think it is. It's down 433 today. I think Friday, today's Monday. Friday, I think it was down 500 plus. And the story here is that they're blaming it. I'm just looking at CNBC. They're blaming it on the scariant, and
this variant. But the real problem is the real economy, George. You have inflation and taxes. So their consumer discretionary income. Yeah, people might not go out to eat as much or travel as much, but their discretionary budgets, most people's savings, most people's discretionary budgets have gotten killed. Unless you're very affluent, and you've made a lot of money off asset price inflation. If you're a small business owner, if you're a person who has a salary job, your standard of living the last 18 months, especially 18 to 20 months, the amount of acceleration in the stagflation. I mean, the official inflation rate, the last inflation number, and they were complaining about this, was 6.8%. And they're making a big deal out of that. Let's multiply that by at least 2.
Yeah, I agree.
So the 6.8 number, George, I did a video on this on my YouTube channel, and your listeners can check it out. I did it in the last couple of weeks. The Bureau, and you should definitely do a video on this. The Bureau of Labor Statistics just put this on their website in the last month or so, that they're going to be changing the consumer price index, or changing propaganda index, as I call it, formula again. In January 2022, they're going to be using old consumer price data from 2019 when there was less inflation. It's right on their website. Their screenshot. I have a screenshot of it. It was going around Twitter a couple weeks ago. So their rationale is because of the supply chain crisis and all this other stuff, that this is unstable price data. This is not natural. But look at rent and healthcare and food. I mean, this is the stuff going on in rents is unprecedented. It's a record for a 12-month increase in rents.
Yeah, but let's go back to the market crashing, for lack of a better word, the last couple days here, and them blaming it on the scariant, when I think it's more the blame should be put on them not passing this bill, because that means less government deficit spending. And I sent out a tweet this morning where I said, I think people are getting caught up with the Fed taper, but they should be just as concerned about the government taper, meaning the government tapering its spending, because I think the stock market, and therefore the economy, is addicted to not only the Fed's balance sheet, but the government's balance sheet. So if the government reduces the amount of spending, I think that makes the probability higher that we see a significant downturn in the stock market, maybe the housing market, and therefore the real economy. What do you think?
Yes, but then the Fed, as I said earlier, is trapped, because they're going to have to reverse course on this supposed, and they're saying, reduction in the amount of quantitative easing. Because if asset prices, and this is the problem, we saw this in 2008 and 2009, the Fed panicked and reversed quickly. We saw this with the repo crisis in 2019, when the Fed was hiking rates and doing tapering. Every time asset prices start to wobble or crash, and in early 2020, obviously, we saw this as well. The Fed panics because of how reliant, and this is a major factor that a lot of people don't talk about anymore, because people just assume the Fed's going to monetize all government deficit spending. But this problem actually gets exacerbated now because of how reliant a large portion of the U.S. Treasury's budget now is on capital gains taxes on stocks, bonds, real estate, people trading assets, because of how financialized the economy is. The banks, as I think I've talked about this more than anyone else that you've had on, the large banks here in the U.S., they make way more money selling. They make way more money trading, putting on leverage trades with their portfolio managers on currencies, bonds, over-the-counter derivatives, and they do actually conventional loans, because there's too many rules, regulations, taxes, red tape, and there's caps on the amount of loans, on the interest rates that they can give out.
They're hedge funds.
Exactly. So the banks have figured out ways around the rules, because the banks have all this money to hire lobbyists. And I'll be really honest here. It's very unpopular to say this. If you say this like to the wrong political crowd here in DC, you can get in trouble, even though it's true. But the banks control both political parties.
Right.
So you may see like Elizabeth Warren go on TV and blah, 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 I hate the banks. I mean, look how rich she is. Look how rich like all these Democrats are. And a lot of them, like Nancy Pelosi was getting preferential IPOs for Visa and MasterCard. So, I mean, they'll go on TV and they'll bash capitalism and they'll bash the banks. Meanwhile, they're doing insider stock trading and they're getting preferential. I think one of the guys, he's not in Congress anymore. He was a senator out of Delaware. I forgot his name. He was super corrupt, but he got like a low interest jumbo mortgage. He got like a super low interest jumbo mortgage comped for his like mansion in Delaware. And he was like on the banking committee. So, I mean, like the bribes that these guys get is absolutely nuts.
Yeah. So what does the Fed do? I mean, if we have, let's just assume for a moment that the CPI continues to trend higher. even if it's just up to 7.1, 7.2, 7.3, and we have a downturn in the stock market because of no government spending by, let's say, 20%. What does the Fed and or the government do when they can't really do anything without stoking inflation, which will almost ensure that Biden doesn't get reelected?
So
while at the same time the market's crashing, which to your point will implode the entire economy.
Yeah, the holes that will be blown in the U.S. federal government's budget if asset prices stay low are enormous. At this point, with the rules changes, and this is one of my main parts here of stagflate tax lie, is the lie component. So if I was immoral and if I was morally bankrupt and I was a bankster and I was a central banker and I was running things, what I would start doing, because it's legal now, is they're going to go on TV and they're going to say, we've created a wealth disparity, inflation's out of control, we're going to take a break on this. And then they'll secretly be loading these special purpose vehicles off balance sheet. And Jim Bianco wrote a Bloomberg op-ed about this in March of 2020, I think March or April of 2020. They're just going to move everything up. They're going to go more QE and more covert. In the past, they've bought back treasury bonds in the secondary market. They've been doing this for many, many decades, monetizing debt secretly. It's common knowledge for a lot of the bond traders that they've been doing this, but not at the scale. Since 2008 and 2009, it scaled up. But now that they have these special purpose vehicles legalized, and I haven't seen any legislation out saying that that was taken away, so they can just move more and more covert QE if they want. Now, that doesn't mean there won't be a stock market crash, because the Fed is as efficient as the Department of Motor Vehicles. They just have more PhD economists on staff. There can still be stock market crashes. I think my point here, George, is if we do have asset price crashes, stock market crashes, or temporary deflation, what we've learned, I think, from 2008, 2009 up to now is that they just won't allow it for long periods of time. So
but how do they thread that needle if we have consumer price inflation, but yet we have asset deflation?
Well, if they wanted to fight inflation, they would start hiking interest rates, right? Because traditionally that's the way they did it, but they can't do that anymore because of how leveraged these corporations are.
That's my point. So what do? What's your
trapped and they're trapped. So they basically have to pretend that inflation is not as bad as people are claiming, that it's temporary. They will change the inflation formulas a lot. Hopefully more people will wake up and stop trusting these government statistics. So GDP, at this point, George, in my opinion, it's totally phony.
Yeah. Yeah. It's a complete farce.
They're counting government spending positively, and government spending, depending upon how you measure it, is now around 50% of GDP. And there's obviously welfare payments and social transfer payments in there as well, and other subsidies to people with lower incomes. But there's also a lot of covert bailouts, and there's unbidded contracts in there. So there's all this corporate welfare and covert bailouts in there to the banks, to the large banks here in the US, to big pharma, to the military industrial complex, to other corporations, other large corporations that need the government to give them unbidded contracts to make them profitable.
Yeah, and the deflator's a joke. I mean, the deflator's 3 when it's really 10. That means negative real GDP.
You're preaching to the choir here. I mean, the cost of living adjustment that we had earlier this year was a record. It was the highest in like 40 years, I believe. So the cost of living adjustment, I did a video on this on my YouTube channel many months ago, like 6 months ago, I want to say. And that was tens of billions of dollars in additional payments to Social Security, government employee pension plans.
Yeah, right.
And if that continues, the government's going to have to keep paying more and more out. So they're going to look for an excuse. This is why stagflate tax lie is the main game plan until there's a new global financial system or some type of reset.
Yeah, so we're talking about the lying component of that. Do you think that if that lying component doesn't work, and what I mean by that is this scenario where the government or the Fed are saying, oh, well, CPI is actually, this is great news. It's gone down to 6%. But still, the voter is going to be basing their decision on grocery prices and fuel at the pump and their rent. And you can't lie on that one. And so do you think that the government will get to a point where they'll institute price controls to try to make it seem as though they're taking bold action and they're doing something to try to get those constituents to vote for them again.
Well, Biden has talked about doing that to big meat, right? Trying to make big meat the enemy. Have you seen any of that? when the White House is not releasing propaganda on its Twitter, where they mess with the Excel spreadsheets there to show a 10% drop in gasoline prices as a major achievement.
Oh, right.
Despite them, in order for them to knock the gasoline price down last month, right after Thanksgiving, they had to collude with 5 or 6 other governments to get them all to agree to dump oil, millions of barrels of oil. Who knows the real number? Who knows how many governments exactly participate or the real number to dump oil from the Strategic Petroleum Reserve? That's instead of actually the problem is all these. It's not capitalism or free markets. The problem is politicians, bureaucrats, and regulators, because business owners could solve consumer demand. A lot of these supply chain problems could be fixed a lot faster, but for politicians, bureaucrats, regulators making the lives of business owners trying to solve these problems, supply chain problems, a living nightmare.
Yeah. And to exacerbate that problem, we have areas in the United States like New York that are just going completely off the deep end. And making the lives of small and mid-sized business owners there a living hell, along with their employees. And so I don't want to get into the weeds about whether that's right or wrong, but let's just look at it through the lens of economics. I mean, it's just pretty basic that wealth is a result of people producing more than they consume and producing goods and services. So what happens to the level of production if you have all of these mandates and you say that 20% of the employees have to be fired and that there's a large portion of the United States that can't even participate in the local economy? Do you see that spreading throughout the rest of the United States potentially? And then what would that do to stagflation?
Well, a lot of the U.S. is stagflation, and it's not just, you brought up like the U.S. creating enormous amounts of currency and credit, and they have. But a lot of other countries also run dollar pegs. So if the U.S. creates currency units, base money supply increases in the U.S., other countries copy the U.S.'s, other countries' central banks copy the U.S.'s policy, or they prop up the dollar and they devalue. And the U.S. imports a lot of goods and services. So a lot of that stagflation and shrinkflation is actually imported from the goods and services that the U.S. actually brings in. In terms of what you said with the U.S. economy, I think you've seen this the last 20 or so months where a lot of people, and this was starting before the pandemic, but a lot of people, you mentioned New York, I have a lot of family from there. I mean, a lot of my family didn't want to pay the property taxes, all the other crazy taxes that were being jacked up all the time for years. They left. So they moved to lower tax states like Florida and elsewhere. So you've seen a lot of that. People, I think, first, before they stop producing or leave the United States, they may move to another new state or two. But unfortunately, I don't think a lot of humans, George, learn from their mistakes. A lot of adults don't learn from their mistakes. So you're going to see a lot of the same problems with the voters. A lot of the political problems are going to be repeated. So yes, in the upcoming congressional elections, and we saw this here, I live in Northern Virginia right now. We saw, I wasn't shocked at this, but we saw that Virginia actually voted against, despite Northern Virginia being super hardcore Democrat, because of how a lot of Democrats have moved here for decades now to work for the federal government in Fairfax County, Arlington County, etc. You saw a big flip in the local state elections, and then also at the congressional seats and Senate for Virginia. So you did see some major seat changes in Virginia. I think that you're seeing with the political betting, you're seeing that's going to happen. But even with that, even if politicians that are elected will slightly reduce taxes, will get rid of some rules, regulations, red tape, some taxes. I mean, overall, I don't see the size of government in many major cities, states, and especially at the federal level being cut. And that's the major problem. So there's so much wasted misallocation of capital, trillions, and so much waste, fraud, corruption, and abuse. And there's lots of people, parasites here in the DC metro area, especially, that get rich or richer from it, that it is extremely entrenched. So like all these change candidates at this point, George, they can't really do a lot of change, especially here at the federal level. The system's going to have to run its course, and there's going to be a lot of cheating and rules changes, accounting fraud. They'll move stuff off balance sheet. I mean, look at the accounting gimmickry that the Pentagon's allowed. So the Pentagon, if a private sector companies were doing that type of accounting fraud, there would actually be, it's worse than Enron. There'd be people in prison right now.
Yeah. Let's go back to the Fed tapering and tightening. Let's just assume for a moment that the government spending stays where it is. Let's just assume they pass this Build Back Better thing, which the probability is low, but let's assume they do for a moment. How far do you think the Fed can go before they implode the market, the stock market? Like, do you think they can get all the way down to zero, or do you think they could actually raise rates once, twice, three times? What do you think is the highest probable outcome?
Wait, you mean a stock market crash or interest rate hikes?
Well, I'm saying how many interest rate hikes do you think they can do before they crash the market? Or do you think they can even get to one? Do you think just the fact of them reducing QE down to zero will crash the market?
So I don't think they will reduce QE down to zero, because I think they're going to still have to buy a lot of these. I think secretly the Fed's been buying a lot of commercial real estate mortgage-backed securities. Just the anecdotal stuff I've heard from commercial real estate and the lack of bricks and mortar traffic, I really think the Fed is secretly buying from a lot of large banks here in the US a ton of commercial real estate mortgage-backed securities. We know that they've bought a lot of regular mortgage-backed securities, and people are shocked that they're still buying an enormous amount of regular mortgage-backed securities for residential homes. But I think there's a ton of covert toxic sausage for the commercial real estate. But if those interest rate hikes do happen, George, the interest rate hikes would benefit US Treasury demand here in the US, but they would blow up. This is why the Fed is trapped in a lot of different aspects. Interest rate hikes, they would benefit US Treasury demand, at least on a relative basis, relative to other foreign bonds, foreign government bonds, but they would start to blow up Wall Street banks' ability to sell junk bonds, to sell leverage loans, to sell collateralized loan obligations, because then people are on a relative basis going to want to look at US Treasuries instead. So the Fed here, they can hike rates maybe once or twice, but they're playing the economy. They should have hiked rates a long time ago.
Yeah,
but right. They sent such a bad signal. They were so worried about asset prices collapsing. Higher asset prices were, I've talked about this with the wealth effect. The Fed won't publicly talk about the wealth effect anymore because of the wealth disparity now, because of the wealth gap. Now it's obvious to everyone. But for 2 decades, you had the Alan Greenspan Fed, the Ben Bernanke Fed, the Janet Yellen Fed, all endorsing the wealth effect, which is a version of asset price inflation and the Cantillon effect. They're publicly endorsing that, saying higher asset prices. Ben Bernanke wrote an op-ed in November 2010 in the Washington Post about this, saying that higher asset prices would be good for the economy. It wouldn't increase the money supply. He promised it. We wouldn't have a money supply increase like what we've had the last 20 months. He promised that quantitative easing wouldn't do that. And he said it would not affect consumer prices. So he said all these higher asset prices, stocks and real estate would allow the consumer then to feel happy and spend more. And for a short amount of time, people did. So we had a fake artificial recovery after the technology stock market crash. And then after the 2008, that's why the stock market didn't crash more, because asset prices were inflated and they were pretending a recovery. But now I think the pretense is off, because now we have in the real economy, a lot of people are well aware, and politicians, like you said, are going to get voted out, but there's not going to be any meaningful change because the size of government's not going to be cut. So, okay, they can fire 20-30% of all the Democrats in Congress, but are Republicans really going to cut spending? Are they going to cut taxes drastically? And are they going to, more importantly, are they going to cut government spending drastically? And I just don't see that. Yeah. In fact, in a lot of states where a lot of Republicans have taken over, I mean, property taxes eventually go up. Look at Texas in many cases.
Yeah, exactly. So how isolated do you think, or insulated, maybe is a better word, are the states like Florida, Texas, Arizona, maybe Idaho, maybe a couple others in there, from the insanity that is spreading on the East and West Coast, like in Oregon, California, Washington, New York, etc.?
I don't think they're that insulated, because I think, and I said this earlier, a lot of people, a lot of more affluent people are going to move to those states, and they're not going to learn anything from voting for bad politicians and bureaucrats.
So they become purple. So they become purple.
Well, look at Nevada. Look at a lot of these states that have changed a lot over the years. Yeah. So actually, most people aren't aware of this, but many decades ago, New Jersey actually used to be low taxes, low regulation. So a lot of New Yorkers, I think in the 40s, 50s, went from New York to New Jersey to escape all the taxes, rules, regulations in New York, and then they moved to New Jersey. Now New Jersey is insane with rules, regulations, taxes. I mean, there's a lot of CPAs and tax attorneys that say, don't die or don't get divorced in New Jersey. That's how crazy a lot of the tax laws are.
Yeah.
The state taxes if you own a business or have a lot of assets. So, I mean, states, my point, George, is that over time, like these states, things change. Human beings don't really learn a lot of the lessons. This is why history basically repeats itself in cycles.
Right.
The main lesson from history is that people don't learn anything from history, and humans repeat the same mistakes over a certain amount of time. Painful lessons of the past from past generations. Painful lessons are. I messed up that quote, but painful lessons from past generations are forgotten over time.
Yeah, that's so true, and we see it just playing out everywhere. I did a couple videos today on the mandates at de Blasio and him. I don't know if you saw that thing going around Twitter where he went on CNN and he publicly stated, like just, this wasn't out of context or anything. I saw the actual video clip, the whole thing, of him sitting there saying that in the future they should just take away people's paycheck. They should take away people's ability to enjoy their life. I mean, he's saying these things out loud. Basically, if you don't agree with him, he should have the right to take away your freedom, your life, your ability to enjoy your life. He should control what you do with your kids. I mean,
and he's already rich. Yeah. He's a champagne socialist, and his daughter's a trust fund baby. So these people are just hypocrites. It's unbelievable. Yeah, the level of hypocrisy that these people get away with.
Yeah, but you hear him say these things, and you're like, first of all, I can't believe it's coming out of even a politician in the United States. I can't believe I'm hearing that. But it would seem like something that would come out of the mouth of a dictator in the 1900s. Let's just put it there. I mean, it seems very consistent with what you would hear. So my point there is that how can people not just look at history and see the parallels with what is happening today? Going back to your point of history just repeating itself in cycles.
So I get asked this question a lot, and people want easy solutions to problems that don't really have definite answers, because the rules, unfortunately, people want an easy solution. And I'm trying to tell them, like, look, all the tax laws for all these assets, because right now, and it's whether you're in the United States or many other countries, Latin America, South America, they're raising taxes on the mining companies like crazy, because commodity prices, the copper price in early 2020, it got below $2.30 a pound. Now it's over $4 a pound. And in a lot of these countries, copper is one of the main exports. So these governments, with the rest of their economy shut down, they're looking at that tax base and seeing like big dollar signs. So they're hiking taxes. They're going to potentially crash their investment, foreign direct investment into their companies. They could potentially, so a lot of these my point here is that a lot of investments, you have to pay attention now, whether you're investing in real estate with a rental property owner. All these rules, regulations changes, they could change the tenant laws. Property taxes could go up rapidly, making it very difficult to be with the math, to be a good rental property owner. Mining companies, the rules, it's not just in normal emerging market countries. So a lot of these more developed countries, the tax laws are going up on mining companies, or the mining company in the case like Newmont Mining, and you're seeing this all over Twitter, Newmont Mining, and we talked about this with the interview on your other channel last week. Newmont Mining, from a numbers perspective, is a very solid gold miner. Yes, their costs are up. I think in early 2020, they were a little above $800 an ounce all in. Now their costs are up like double digits. So they're up around $1,000 and a little over $1,000 an ounce. So those costs are up like 20% over the last 20 plus months. Still a pretty low cost producer with a dividend, but they're putting all these policies in place with their employees that if they don't get the jab, then they're fired.
Because they're based in Australia, right? Weren't you saying that?
The CEO is Australian, and there's a lot of pressure, I guess, because he's probably, since he's running a large gold mining company, probably got invited to Davos. They're probably going to send him a private jet. You know, once you're in the Davos crowd, there's a certain level of expectation, certain things you have to do. And if you deviate from it, you get blacklisted, where you can't go to the parties and you don't get all these other. So there's like social pressure and political pressure. But the main thing here with your listeners here, this is an investment channel. You're going to have to pay attention a lot to all the tax law changes. It's going to be an absolute nightmare, a mess. You're going to have to check weekly or monthly now on everything, on all assets you own. If you own a business, your investments, it's a mess, unfortunately, because these governments with bad policies from politicians, bureaucrats, regulators, central bankers, there's been so much stagflate tax lie in all these different countries that they're going after assets and tax revenues wherever they can. So if there's an industry, and commodities have done very, very well. So you've had uranium stocks up, natural gas, oil's had a nice rally, potash stocks are starting to do well. These companies could do very, very well for, I think there's going to be bull markets for uranium and natural gas for many, many years for a lot of different reasons. We can maybe talk about that a little bit later in the interview. But if politicians and bureaucrats decide and regulators decide that you can't open a uranium mine or you can't build nuclear power plants anymore, they could just shut down these bull markets.
Right. Well, but do they though? Because let's talk about that, because I think you're referring to ESG with no more capital going in to produce more supply. But does that, although that may curtail demand, if that strong narrative is there, if there's zero supply coming online, the demand doesn't go down that fast, and then the price just really starts to go up.
Well, ESG, so ESG is only part of it. What your listeners really have to understand is that DC loves to come up with these crazy spending programs. So the larger the spending program now, that money does not go into the real economy. That money is corporate welfare. That money is, a lot of it is stolen, secret ballot. So the more DC spends on paper, the larger the bill, the more stuff that can be hidden in the bill, the more stuff that can be stolen, the more favors that can be traded, the more unbidded government contracts. So everyone, when these bills come out, like an infrastructure bill, the infrastructure spending might only actually be like 10 or 20%. And then that money, a lot of it's going to be wasted. It's going to be on unbidded government contracts, whoever handed out the most bribes. The majority of the bill is not going to have anything to do with infrastructure. I've seen this for I've been here for over 20 years. So that's why DC loves these big bills, because the average American doesn't understand how the sausage is made. And so
they just look at the title of the bill and think that every penny is going to that cause or that intention.
Yes, ESG is a scam. So a lot of corporations, so basically like Goldman Sachs and these others are going to set up carbon cap and trade. Goldman Sachs can then take a cut of all this other tax revenue or all this other carbon cap and trade revenue. That's probably that they've been talking about this for over a decade now to set up something like that. So the more ESG is pushed, but there should be investments. We were talking about market manipulation in oil. If the Biden administration, then they were blaming OPEC, and what they should have done was just approve oil and natural gas leases on federal lands in New Mexico, which were blocked. So they and then approve pipelines. And then approve oil refineries. So there actually hasn't been a new oil refinery. And this is why, even though oil prices have crashed a little bit today, they're down almost 4% today. This is why gasoline prices in the US are still over $3, because there hasn't been any new oil refineries built in the US for decades because of all the rules, regulations, red tape. So all the oil refineries that we have are all very old ones that have been upgraded. And then that's inefficient because regulators say that we should just upgrade the existing refineries, but then there's all these rules, regulations, red tape on those instead of building new oil refineries. So the investments that should be made into energy with better nuclear power, investing in research and development for better nuclear power technology, that's not being done. We talked about in past interviews with natural gas storage tanks. That was not done. Real good infrastructure would have been for the last since 2008 with all this shale gas byproduct that we flared off. We could have stored it in natural gas storage tanks. So we would have an extra 13 years then, for almost 14 years of natural gas put in storage tanks. Instead, that was flared off. It was just burnt. It was wasted.
Yeah, right. Yeah, that's government in a nutshell. Although that wasn't government. That's a good analogy, I guess, for how government spends money. It was kind of the entire shale industry.
Well, shale was done to protect the petrodollar. So that was one of the main reasons. But we discussed in the last interview that the petrodollar is not as important now. But at that time, the last time, in my opinion, the petrodollar was important was during the 2008 financial crisis. So that's why the shale industry, it was extremely unprofitable for the most part. That's why it was subsidized. They tricked pension funds into investing trillions. Wall Street funded it. The Fed subsidized it. So the oil production growth, the U.S. could say at one point, the U.S. grew oil production more than Saudi Arabia, but it was extremely high cost and extremely unprofitable compared to Saudi Arabia.
Yeah, therefore unsustainable.
Yeah.
And it just kind of a money pit.
But George, the U.S. was able to have all that extra oil revenue and export some of that oil. So that had the narrative that the U.S. economy was still doing well from 2009 up until the 2019 repo crisis. I mean, the problem started before the pandemic. The repo crisis, I think a lot of things broke during the repo crisis, just with hedge fund leverage. There were a ton of, the Fed's balance sheet went up $1 trillion officially in only a couple months.
Yeah, let's go back for a moment and kind of, before we hit the record button, you're talking about some of the commodities you really like. And I know this is kind of your area of expertise, where you're great in macro, you understand it just as well as probably anybody out there. But where you really take deep dives are with these companies in the commodity space. So we discussed gold the other day. People can go to my other channel and check that out. But you've also done these deep dives on other producers in the uranium space. And I don't know if you've gotten to nat gas or coal as well, but can you expand on that?
Okay. So in China, there's really bad stagflation right now, even though unemployment's also rising. And a lot of it's because of bad central planning. The People's Bank of China, their central bank, is printing enormously to try to prevent real estate, to bail out their state-owned enterprise banks. And that's why you haven't seen banks fail. But there are legitimate electricity shortages and legitimate energy crisis, especially for cheaper electricity. And there's lots of videos that your listeners can go see on YouTube now. One of the best YouTube channels is China Insights. There's been quite a few videos out in the last couple of weeks interviewing business owners in China, factory owners, talking about their energy costs are up 10x or more. And so China has had, and it's not just China that has electricity and energy shortages. It's also the European Union. It's also the United Kingdom. So the natural gas price rising a lot. And there was a ton of natural gas supply that came offline here in the US. The US was one of the major exporters of natural gas because of all that shale gas. But so much supply came offline that you knew that the price was going to have to go up. Now, the natural gas price was one of the top performing commodities in 2021, the US natural gas price. The foreign natural gas prices are up even more than that. In the last, I would say 2 months, the natural gas price in the US has come down a little bit. But over the long term, So over the next 3 to 5 years, natural gas, I think, is in a bull market because demand is steadily growing. The major demand component, and this is more stable than oil demand, is for cheaper electricity. So there's only 2 forms of electricity now, George, that can handle baseload power electricity generation, and it's not wind and solar. So wind and solar is where all this ESG investment, and wind and solar are not really that clean because solar panels, a lot of them don't last very long, and they're made with a lot of dirty, especially rare earth elements. The large wind turbines, the motors, and a lot of parts in the large wind turbines, and then also solar panels. A lot of them are made with rare earth elements, and those things are extremely toxic. Right. With the air, soil, and water to mine, they're an enormous pain in the ass to separate on the value chain. So governments are allocating, because the energy markets are heavily politicized. But the 2 best forms for electricity power generation, the most stable for baseload, are nuclear power and natural gas. So natural gas is cleaner burning. So I think that politicians, they kind of realize that if they're going to force people to buy more electric vehicles with tax credits, that they can't shut down so they can go after coal. And they're starting to threaten to go after oil more. They're blocking drilling leases. If the oil price continues to go up, then Congress will bring the oil executives in front. They could threaten windfall profits taxes. They could dump. Well, that is just temporary with the manipulation to dump the strategic petroleum reserves. But I don't think they can do that on natural gas. There's no strategic natural gas reserves either. Right. Because countries don't keep natural gas storage tanks. So natural gas, I think, is in a long-term bull market. In the short term, natural gas could still correct. For the uranium market, there's now 3 physical uranium ETFs. The major one is Sprott Inc. I've recommended this publicly. So Sprott Inc., they don't mine, but they invest in a lot of commodities producers. And then they also own all these really interesting commodities trusts. So they own physical gold trust, physical silver trust, a mix of gold and silver, a platinum trust, a palladium trust. That's a mixed one too. And then they just started early in 2021, a physical uranium trust. So instead of buying these trusts directly, where you're not going to get paid a dividend, and this company has done very well, you could just buy shares on the dip if you want a dividend stock of Sprott Inc., and you're going to get a diversified basket then of commodities exposure with these different trusts. Right. But uranium has a bright future because you have these trusts now stockpiling uranium, and there has not been a lot of new uranium supply brought online. And it's going to be really tough in the developed world for a lot of these uranium miners to get permits to mine, because obviously uranium is radioactive. There's a lot of problems with uranium mining, with the water, with treating it. So it's really a pain in the ass for the rules regulators and politicians, bureaucrats, and regulators. And a lot of them are anti-nuclear anyway, because they're on this ESG agenda with solar and wind and advanced biofuels and some of these other green tech. So I think we're going to see a big bull market here in uranium, but it's not going to go straight up, especially if the stock market crashes and asset prices crash. But what's going on in China, George, is really important. We should probably talk about this before we close, because of all the craziness going on with the Chinese real estate prices and the Chinese real estate developers. The People's Bank of China is printing money like crazy to try to prevent their real estate prices from crashing, and they're still crashing. So you've had a paradigm shift, I would say, the last 3 or 4 months in real estate markets in many different Chinese cities. The banks have not failed yet, but commodities demand for food, energy, and also for physical demand in China for gold, silver, and platinum, it's absolutely exploded.
So, I mean, I'm trying to kind of think through what that means for global macro if China goes into a recession as a result of their real estate market tanking. And, I think that it sets a bid for the dollar. And I want to point out to everyone that you've nailed the dollar really for the last year and a half, because everyone, Brent was talking about the dollar going to 110. Luke was talking about the dollar going to maybe 85. And you came out with your dollar tug of war theory. And that's really what we've seen play out. So congratulations there. But how do you think that the situation in China that people have kind of swept under the rug and they're not really paying attention to anymore, how do you think that plays out with the global economy?
So China is a mess of central planning right now, a mess, many trillions, tens of trillions in misallocated capital.
Yeah.
I was just watching a video on China Insight over the weekend, and there's Chinese companies. First of all, the Chinese government over the summer, they banned private sector education companies.
Yeah,
so that was a large industry, and the Chinese government just decided we don't want it anymore. So all these employees, tens of millions of employees, are going to be out of their jobs. If they haven't already been fired, they're going to be fired in the next 6 months. And yet the Chinese government is still printing to try to bail out the banks for bad real estate loans and to prop up real estate prices. So you still have, even though you have unemployment, wide scale unemployment now in a lot of major Chinese industries. So Chinese technology companies, the large ones, are firing. They either have already fired 30% of their workforce, or they're going to in the next 6 months. They've announced fire 30% of their workforce, but the government is not allowing deflation, at least not allowing like normal deflation. So you're seeing, and then the Chinese government has issued official warnings about stagflation and then told people to stockpile food and energy.
How is the Chinese government printing like what's the process there? Are they just deficit spending more?
I think it's very similar to what the Fed did with the large US banks in 2007, 8, and 9. So they see that the real estate crisis could get worse. I think there's a couple major differences here between the real estate crisis in the US, the real estate bust in 2007 and 2009, right, and the one in China. So the one in the US, okay, let me do China first. First, China has at least 65 million, and that number is probably low, empty homes. So these are either unfinished homes, partially unfinished, or unfinished homes. And these things are in disrepair. So these basically, a lot of these homes could be knocked down. So these were homes that were built. The developer probably unloaded them to someone else, or they're sitting on the developer's balance sheet. Or there's tons of pre-sale scams where they've collected either a large down payment from people, or the people have paid in full and the developer did not even finish part of the house.
Yeah. Right.
So the real estate developer, if they declare bankruptcy in China, the person who put down the down payment or paid in full is going to get fully screwed, because the bankruptcy laws in China are not as good as the ones here in the US. But in China, you have the shadow banking system, but that's different. It is large, but it's different than the amount of derivatives that were tied to the housing bubble with credit default swaps on the banks and other derivatives in 2007, 2008, 2009. So it's similar, but there are also differences. So there's a lot more empty homes in China. There's a lot more wide scale home ownership in China, but now you're starting to see that people, very similar to the US, are upside down in their mortgages. So even if they walked away from, if they tried to walk away, they would still owe, if they sold their house or tried to walk away from it, they would still owe more money than the house is worth on their mortgage.
Right.
But there's not the derivatives that were tied to that, unless there's there could be some derivatives in the Chinese shadow banking system, but it's so opaque, no one would know. But right now the Chinese government is printing, and this is why you have not seen any headlines yet that this is why you have not seen any headlines yet that any of the major Chinese banks have failed, because they're probably monetizing that bad debt. They're probably taking it off the books. What they did also was they lowered the reserve requirement for the banks. Normally what people say when the bank's reserve ratio requirements are lowered, they say that that's bullish, that the banks could lend more, but actually in times of trouble, when they do that, it's to make the banks look more solvent than they really are. So if you lower the reserve ratio requirements more, and the Fed did this, they took it down to zero, basically, in 2008.
Yep.
This is how insolvent the banks were. So there were banks, a lot of the banks, because of how insolvent they were before the Fed started buying up all this toxic stuff in 2008, the banks were leveraged 60 to 120 to 1. That's how leveraged they were before the Fed started taking So there were actually a lot of banks that were even more leveraged at one point because of how bad the real estate prices crashed than Bear Stearns and Lehman.
Yeah, right.
So all the bank, like Citibank and all the others, were massively over leveraged. So when the reserve, things are bad. So they're saying that like, oh, we're going to allow the banks to inject more credit. That's not why they're doing it. So that was like the false narrative that was put out in China. It was to make the banks look more solvent while they try to fix the bank balance sheets with the bad loans.
Yeah, because they're the ones that are holding the bag on all these ghost cities that were just complete, total malinvestment.
But they're allowing the real estate developers to fail, though, or at least default on foreign bonds. So the dollar-denominated debt, they're allowing the banks to fail on that. They're screwing over foreign bondholders. The bankruptcy laws, especially for foreigners in China, are not good.
Yeah.
And yet you see a lot of Westerners still invest in China, especially like the BlackRocks. Well, that's probably a lot of it's political or bribes.
So I found it interesting that you have a very similar view to China as Hugh Hendry. I just spoke with Hugh last week. We uploaded that interview on Friday night. And what's interesting is Hugh went to Wuhan, China in 2009. And, back then, that was before he retired. And he went there specifically so he could see with his own eyes what was happening with the Chinese real estate market. And he put on a bunch of trades because he thought the whole thing was going to blow up. But he said he was 12 years too early. And he says now he thinks his thesis back in 2009 is actually going to play out. So I asked him, I said, okay, Hugh, if you were running money today, how would you play it? And the first thing he said is he'd probably short the yuan. What do you think about that?
I would not bet against the Chinese central bank. It's more likely that they could take a break from maybe stockpiling some of these base metals like copper and iron ore, but then the mining companies won't make investments into new supply. So that will correct itself within I would say 2 or 3 years. So you could have, if you have temporary deflation where asset prices crash, where the Chinese government makes even more mistakes, because obviously there's a lot of mistakes being made now with the US and China. All these governments are making mistakes. All these governments and central banks are all making mistakes. The difference here is that a lot of these central banks just paper them over. So if we didn't have central bank intervention, we would have free market forces. We would have deflation. We would have debt deflation and wide-scale bankruptcies. We have politicians and bureaucrats and central bankers trying to prevent that, at least in certain instances, and they're picking out winners and losers. Like in China, in this case, a lot of the property owners are going to get screwed. The Chinese banks for now are being saved, and the Chinese real estate developers are the ones being allowed to fail. I don't know how many of these Chinese real estate developers executives are going to go to prison or they're going to be sentenced to death, because being a billionaire in China is very, very dangerous.
Right. But don't you think that them trying to paper over the problem is going to potentially force them to depeg?
They could repeg at a new exchange rate.
Yeah. So yeah, that's especially if the dollar continues to go up, on the DXY because of all these other factors we're talking about: global dollar denominated debt, Eurodollar futures curve, all that stuff.
I would be more rather than shorting currencies, because I know people like Stanley Druckenmiller have made enormous sums of money on currency bets, and like George Soros and Stanley Druckenmiller, those guys are the ones who made enormous sums trading currencies. I think like if we do have China where we have wide scale defaults, housing prices keep dropping, I think that will affect base metals more. So I think base metals.
Got it.
But then you have the Latin American governments that are putting all these taxes, that are starting to hike taxes because they see the copper price right now is over $4 a pound, and they're putting on large royalty taxes, whether that's Chile and Peru's talking about tax hikes on miners. I think they're the second largest copper producer in the world. So you could potentially have some supply problems too. So if they put restrictions on the miners, so you might not see commodity prices stay that low. And normally, George, what happens then is governments decide they want to print. So I think stagflate, until we have a new system, until we have a totally new global financial system, I think the preferred policy methods here are still stagflate, tax, lie. Now we could have temporary deflation, but it might only last 6 to 8 weeks. It seems that that's like the right amount of time now for where the Federal Reserve will issue the right amount of press releases after asset prices crash to try to get them to rally. Because if the asset prices don't rally, George, if they stay low, the Fed has to plug the holes in the U.S. federal government budget deficit, in the U.S. federal government tax revenues, for capital gains taxes on stocks, bonds, real estate. And then it becomes a vicious cycle. And you and me are the only two people talking about this. If real estate prices crash and stay low for 2 or 3 years or 4 years, what's going to happen then to property taxes? In China, and this is their pyramid scheme, their real estate scheme for a lot of these provinces and cities, 84% of their government budget is on rezoning land. So this is farmland that's either not being used right or not being used at all, and then sold to the real estate developers for luxury condos. So what happens when real estate prices crash and governments can't do that for their government budget? 84% of their government budget. Here in the US, it's not quite 84% for property tax revenues, but I would say a lot of these state and local governments, they're reliant on their annual tax revenues, 50% or more property taxes. What happens if property prices crash? Then those state and local governments are insolvent.
And you know what's interesting about that concept, Jason, that I've never really heard anybody articulate. I've tried to articulate it on a couple of my whiteboard videos, but people assume that inflation is good for the government because they paid their debt back with cheaper dollars. But what that means, if that comes to fruition, if that plays out, is that inflation creates an environment for the government where their tax receipts are increasing. But what we could see, because now the tax receipts aren't really a derivative of consumer prices, they're more so a derivative of asset prices. You could see in a world where we have high rates of inflation, but yet the tax receipts are actually going down, not up, because consumer price inflation goes up, but yet nominal prices of assets are going down. And it's this very bizarre world that I don't think we've seen in the United States before. We've made this slow transition to where the majority of the tax revenue is a result of asset prices. I think that's been happening since the 1990s, but we've never gone into severe price inflation while we've lived in this financialized world. And yeah, to your point, I think you and I are pretty much the only people that I know of that are discussing that.
So the tax base would have to change again at that point. It would take a long time to change it, though, because then you'd have to start making drastic changes.
Yeah, I don't even know how you would change it. I mean, and if people want some data to back this up, all I have to do is just look at the tax receipts as a percentage of GDP. And you'll notice that it really doesn't have anything to do with the highest marginal rate. It really has to do with what's happening with the stock market. So if the stock market's going up, then you see the tax receipts increase as a percent of GDP. If the stock market crashes, then you see those receipts decrease.
And this is also why I said, even though governments don't really like Bitcoin too much, they like the tax revenues from Bitcoin and cryptocurrency trading.
Right.
So while they transition to digital currencies and central bank digital currencies, and they scale things up with pilot programs and cross-border trade settlement with they do cross-border trade settlement with central bank digital currencies. They're still testing that, and it's nowhere near the scale that the global economy is. So if Bitcoin were to say, and this is hypothetical, I'm not predicting that Bitcoin's going to $1 million in a couple of years or anything. Maybe in 5 or 10 years, it'll go to 6 or 7 figures. We'll see. But if it does, from a return on investment for the US government, for government spending, so for an infrastructure program or government spending program, the government doesn't have to spend anything. No, they don't have to allocate any congressional budgets. They don't have to go through that hassle. So if Bitcoin goes to $1 million or 2 million, imagine hundreds of billions, if not trillions, in extra tax revenues that the government could tax And then they would still be scaling up. So on one hand, they would have all this tax revenue and they'd have a new class of wealthy people. And then on the other, they could still scale up the central bank digital currencies and then eventually just tax and regulate Bitcoin or make you change the tax laws ex post facto to get you.
Yeah, but I think and I'm very bullish on Bitcoin. I think everyone should own it. Maybe not necessarily because the price going up, because it's something that's outside of the commercial banking system. But I think people who own cryptocurrency need to learn the lessons of other commodities. Earlier in the interview, you were talking about how the price of copper has doubled. Therefore, these copper producers have a target on their back with these governments that are trying to squeeze as much blood as they can out of the turnip. And if cryptocurrency is the only game in town, the only asset that's going up, you can rest assured that at some point the government will try to take its fair share, quote unquote, from your capital appreciation. Yeah.
Well, my main point with Bitcoin and crypto is that unlike building a mine, unlike infrastructure programs, unlike a lot of these other investments that politicians are talking about, these congressional spending bills, the government doesn't have to do anything. So if Bitcoin were to 5 years from now go to high six figures, mid to six figures or seven figures, that's a ton, because every time you pay with Bitcoin or every time you trade cryptocurrency, it's a taxable event now. That's a ton extra tax revenue for the government, and they don't have to spend hundreds of billions of dollars or $1 trillion bill headlines to get it. So from a government tax revenue perspective, and look, I'm not a fan of the government, but I'm trying to put my thinking cap on and think here how the government, because they're that desperate for tax revenues. We talked a lot in this interview that if asset prices on stocks, bonds, and real estate stay low for a long period of time, the Fed's going to have to reverse everything they're saying now.
Yeah.
Because there's going to be hundreds of billions, well over $100 billion in a hole in the federal government tax receipt budget. And then the state and local governments are going to have holes. So the Fed will have to plug everything. And this is why the Fed was so quick in 2008 and 2009 for asset price inflation. They were looking at the treasury tax receipts, George, in 2008. They dropped over 30%, I think, in 2008. And that was just the real estate market. The 2008 financial crisis didn't affect the whole economy that much. It was mostly the banks and the real estate market. It wasn't the whole economy.
I know a lot of people in the financial media are looking at Turkey and saying, oh my gosh, third world country, what a joke. How could they ever let it get to that point? But I sit there and say, yeah, but look at the United States, because we could be, there's a very high probability that we are in the exact same position that Turkey is in 2022, meaning that Turkey right now is in a position where they can't raise rates or else they'll crush the economy. And they have to raise rates because inflation is spiraling out of control. And so how is that any different than the situation that we might face right here in the United States moving into 2022 if we see asset prices go down and all of these unintended consequences, these knock-on effects, start to play out?
Well, actually, Turkey is having a lot of similar problems to Argentina and other emerging markets. Argentina has actually been going through very similar problems to Turkey for over 30 years now. Turkey has too much dollar-denominated debt. Turkey, to try to counter this, is increasing gold mining production. So they're actually pro-mining. A lot of people aren't aware of this. They're actually trying to get a lot of foreign mining companies there. They did increase taxes a little bit, a little higher royalty tax on miners, but that's happening everywhere. So it's not just Turkey. I mean, I could name all these different countries that are increasing taxes on miners. I think they put a $90 an ounce royalty tax, a new one for gold miners, but that's really not that bad compared to some of the other. I mean, Chile, we talked about last week how Chile is the Saudi Arabia of copper, and Chile is putting a sliding scale royalty tax. So if the copper price goes to $5 a pound, the royalty tax is going to be astronomical for copper miners, because that's the main product, the main export for the Chile's economy and the main source of foreign direct investment. And this is what the politicians are worried about that are on the other side of this, that don't want to increase taxes, that want investment and want jobs into their country. the politicians in Chile and Peru, they're arguing that, well, if we raise taxes too much on our best source of investment and exports, we're going to kill that industry.
Yeah.
Politicians don't learn, though.
Just before we close here, I want to try to think that through, because I know a lot of people are really interested in the commodity space. You talked about that affecting the supply side of the equation. Do you think that the producers will try to pass those additional costs of taxes through to the consumer, and we see price increases as a result of them trying to pass on the cost? Do you see that happening in addition to there being less supply for
miners cannot do stuff like that. So they're not a consumer business where they can just subjectively increase prices.
Right. Because
so if you're like if you're a direct retailer or a wholesaler, you could increase prices, but a miner commodity producer can't do things like that because they have a futures market, and they have to basically, for a mining, depending upon the type of a miner. So gold and silver miners don't even get spot prices because they're not making 4.9s. They have to sell. They're not making 4.9s gold and silver themselves. They have to make doré bars. Doré bars are like a mix of gold and silver, and they're not refined enough. And then the miner then sends these doré bars to a refiner. So the refiner are the ones that are getting the spot prices. The refiner, normally the miners are selling their gold and silver at somewhat of a discount because it's too expensive for the miners to vertically integrate. I don't want to go into all the details, but basically, like, the miners, in many cases, a lot of them are not getting full spot prices anyway, because they're selling at a slight discount to the refiners, because the refiners have to do all this. The average person who buys physical gold and silver doesn't understand all the steps that it takes to get your pretty gold coin or silver coin or your bars or your fancy jewelry that's almost entirely metal. There's a ton of steps that are taken before it's mined and refined down. And the miners are not doing everything, but mining is very, very difficult.
Yeah, right.
So the miners cannot, they're not a retail business, so they can't subjectively increase prices.
Yeah, that makes a lot of sense. Okay, buddy, we'll end it there in the sake of time. For my listeners and viewers who want to find out more about what you do, where can they go? They got to check out your Patreon page.
Sure. My Patreon page is only $5 a month. The cost of a Starbucks cup of coffee. There are over 100. That's it. That's the cheapest I can charge. Although with the double-digit inflation, I should maybe charge $6 or $7 a month.
There you go. You got it. You got to keep up with inflation.
Maybe I should put like an inflation increase in there, but there's over 190 articles and audio podcasts behind the paywall. Some of them are like the last 5 or 6 ones are 15-20 minute long audio podcasts on the gold miners' earnings. I prefer royalty and streaming companies because it's like owning a gold mining stock ETF, and you don't have to worry about all these different cost increases.
Yeah.
So the royalty and streaming companies, a lot of them have underperformed some of the gold miners the last 18 to 20 months. But now that the gold miners have sky high costs, the royalty and streaming companies, historically, every time there's problems with the mining companies raising capital or in a bear market, and mining companies can't raise a lot of capital right now, the royalty and streaming companies like Franco-Nevada and Wheaton Precious Metals just do a lot of deals. So this has been the case since 2008, 2009. Every time there's a problem with the mining companies, the royalty and streaming companies just come in and clean up and take advantage and do more deals. There's audio podcasts on the uranium market, natural gas, oil. There's in-depth oil stocks. And then my YouTube channel has almost 2,000 free videos.
Yeah, and it's Wall Street for Main Street on YouTube. And that's the Patreon handle as well, right?
Mm-hmm.
Okay.
Patreon.com/Wall Street for Main Street. WALSTFORMAINST.
All right, buddy. Well, as always, fantastic conversation, and can't wait to do it again.
I always look forward to my conversations, George.
All right. We'll see you soon. Hi, guys. I'd like to invite each and every one of you to the next Rebel Capitalist live event. If you are a fan of the Rebel Capitalist show, I guarantee you will love the live event. The next one is Houston, where you can meet and listen to speakers, all your favorites from the Rebel Capitalist show. People such as Dr. Ron Paul, Chris Cole, Lynn Alden, just to name a few. If you want to check out the rest of the speaker list and find out how you can attend, We'll put a link in the description below, or you can just go to rebelcapitalistlive.com. This is an event where you can learn to build wealth and thrive in a world of out-of-control central banks and big governments. But it's not just about building wealth. It's about increasing your freedom and networking with like-minded individuals, fellow rebel capitalists. It's an amazing event. I know you'll absolutely love it. Check out rebelcapitalistlive.com, and I will see you in Houston.